Well, welcome to the basics, hopefully the basics of derivative pricing and valuation. But as you'll see, it's not all that basic. So we'll go through this kind of carefully, and I'll see if I can be as much help as possible in helping you understand and hopefully remember these important learning outcomes that we're going to achieve here. Well, we start off by talking about how we typically value assets. Our general form is, well, we take the expected future price being at time capital T, and then we discount that. We discount that at 1 plus the risk-free rate, our opportunity cost of capital, but we add a risk premium. We add a risk premium that depends on how volatile or uncertain we are about that future price. If that future price is certain, then we don't have the risk premium. Then we would use the risk-free rate because it's a riskless transaction. So our expected asset price at time capital T, this is our opportunity cost of capital, and this is our risk premium for our uncertainty about what the real value of, what the asset price will be at time capital T sometime in the future. And this risk premium overall in the markets is going to depend on investor risk aversion. The more risk-averse investors are, the more of a premium they want to compensate them for uncertainty about that future asset price. Well, the reason we start with this is we want to contrast that with derivatives values. Now, we mentioned in an earlier reading this idea of no arbitrage pricing, that arbitrageurs would drive derivatives to their no arbitrage prices. And that also is referred to sometimes as the law of one price. Two assets or portfolios or combinations of assets that have the same future payoff, no matter what happens in the future, must sell at the same price. Now, we can replicate certain assets with combinations of other assets. And when they're equivalent, their values must be equal. So we could take a risky asset and add to that a derivative and end up with a risk-free asset. If that derivative just offset the uncertainty about the price of the risky asset in the future, now we've got a certain payment in the future. And so that combination of a risky asset and a derivative security results in a certain payoff. Well, that becomes a risk-free asset. And so the return on that position must be the risk-free rate. Now, the other two lines here are maybe a little confusing, and we don't know enough now to understand exactly what we're talking about here. But the simple algebra is there. If that first line is correct, that the price of this and the price of this is the price of this, then we can rearrange that. So we could say a risky asset, if we borrowed at the risk-free rate, we could create a short position in the derivative. If we had the derivative and finance that at the risk-free rate, then we'd have a short position in the risky asset. Now, there's some limitations on arbitrage. We discuss it as if, yes, no arbitrage prices, they're all the transactions will be done. The markets are very efficient like this. But there may be impediments within the markets on doing the arbitrage. Now, one is the assets may be difficult to sell short. When we do our no arbitrage, you saw in the last slide, minus the derivative, minus the risk-free rate, minus the asset. Well, those minuses mean short position. And if we don't own it and we want a short position, we must be able to sell it short. Well, that's not always easy. It's not always costless. It's even not always possible with all assets. Another limitation on arbitrage is transaction costs. If the cost of getting this portfolio together, buying that, selling the other side, and doing the arbitrage, well, those costs are positive. And if those costs are large enough, then even though there's a small arbitrage profit to be made, it's not larger than the transaction costs you would incur in order to gain those. So in that case, we're within the band of transaction costs either side of our no arbitrage price. We may have lack of accurate information. The example given here is option volatility. We're always estimating the volatility of the price of the underlying asset, usually based on its past behavior. And so when we price these, we're plugging in a value for, hey, how volatile is this price? How much uncertainty do we have about this price in the future? And we don't have accurate information. We're using forecasts. And so that places a limitation on arbitrage as well. Now, some arbitrage may not be risk-free. I think it's come over the last, 10 or 20 years to where we talk about arbitrage that is not risk-free as being an arbitrage. So I guess we can make this more general and say, well, we have risk-free arbitrage, but there's other arbitrage that may not be risk-free. If it's not risk-free, then it's not a certain payoff. Then we need a risk premium in there, just as we did in that formulation for asset prices in general. So now we want to talk about value versus price, right? Valuing and pricing derivatives, that's what we're up to. So consider a forward contract at time zero. We got a long position. We promised to buy a certain amount of that asset at time T, capital T, sometime in the future at that price. And so that price we're going to call F0, capital T. It's the forward price in the contract. The zero there, F0, is because that price is established when we write the contract at time zero. So that is the forward price in the contract, and that does not change over the life of the contract. On the other hand, the value of a forward contract depends on the spot price, expected future price of the asset. So value of a long position in the forward contract is zero at initiation if, and this is going to be our no arbitrage condition. And remember, that price, F capital T, is set at the initiation of the contract. So neither the long side or the short side has any value at initiation. And that's what we're going to describe here. Here's our no arbitrage forward price. Now, we're talking about an asset. It's got no cash flows. You don't get anything from owning it. It's got no costs of storage. And so in that case, this forward price, this no arbitrage forward price, S0, that's the spot price of the asset right now when the contract is initiated, times 1 plus the risk-free rate, to T. That would be T in the number of years if that were the annual risk-free rate. And then we can rearrange that and say, well, the ratio of the forward price to the spot price is 1 plus the risk-free rate for that time period. And why is that the no arbitrage price? Well, if the forward price were too high, higher than its no arbitrage value, we would sell the forward, borrow at the risk-free rate, and buy the asset. So selling the forward, that means we promise to deliver the asset at time capital T, at expiration. So we've promised to deliver the asset. We borrow some money at the risk-free rate and buy the asset and store the asset. And here, in our first simple example, there's no storage costs. So one way to think of this that may help is that how do I create an asset at time capital T to deliver under the forward contract? Well, I buy it now and I store it until time capital T. So sell the forward, short the forward, and promise to deliver. But you're promising to deliver at a price that's higher than this. So we're talking about a situation where that forward price is greater than that, because this is exactly what it costs me to deliver that asset and get the forward price at time capital T. Because I buy the asset for this, my costs of those funds that I borrowed at the risk-free rate to fund that purchase and storage until time capital T is right here. So buy it and store it, create it. If the forward price is higher than your cost to do that, then there's an arbitrage. Sell the forward, buy the asset, store it, deliver it, collect F capital T at the expiration of the contract. On the other hand, what if this forward price is too low? What if it's below the no arbitrage forward price? Well, in that case, we're going to short the asset. We're going to invest the proceeds of that short sale at the risk-free rate. And we're going to go long the forward contract. So how does that work? Well, we sell this and get S0. We invest S0 at time 0, that much money, at the risk-free rate, so that this is what we will have at time t. So at time t, we're short the asset, we need to deliver it, but we've invested that money, so we've got that much. Now, if the forward price is too low, then we deliver it, we buy it at this price, use it to cover our short position, and keep the excess of funds because the right-hand side is larger than the left-hand side. So if the forward price is too high, remember, buy low, sell high. If the forward price is too high, sell the forward, take a short position. If the forward price is too low, I'll promise to buy it in the future, I'll short it now, cover that short in the future at price FT, but have earned more money than that in the meantime by investing the funds from the short sale at the risk-free rate. So that's our pricing. That's our no arbitrage price. The value of a forward contract at time t, any time during the contract's life, is represented by this right here. It's the same kind of thing, except here, this is time remaining. Capital T, that's how long the forward contract, that's when it expires. Little t is something bigger than 0 after initiation, but less than capital T. So that's how many periods are left, and that's our exponent on 1 plus the risk-free rate here. So at any point in time, the difference between the spot price at that point in time, little t, minus the present value of F capital T, this is our forward price. So if the spot price is greater than the present value of that forward price, then the contract has a non-zero value. And at settlement, it's just the difference between the spot price and the forward price. So we're talking about a long position in this forward contract. If your long position in the forward contract at expiration, if the spot price of the asset is higher than the price you promised to buy it at, it has value at expiration. So there's our distinction between pricing and valuing these derivatives. Forward contract specifically here. The price is that no arbitrage price that is set at contract initiation, so neither side has a positive or negative value. Both sides have 0 value at initiation. That's what that no arbitrage price that we set means. This is the value over the life of the contract as the spot price of the asset changes over time. Well, let's add some complications here. That was too easy. We didn't have any storage costs, and we didn't have any benefits of holding the asset. So now we're going to generalize this no arbitrage price and this valuation formula for the cost of carry and the benefits of carry. So far, our cost of carry were simply RF, simply the opportunity cost of the funds to invest in the asset. But it may be the case, if it's a stock, the asset may pay dividends. You've got some income from holding the asset. On the other hand, you may have costs of storage. If you're storing wheat, you're storing gold, you need to pay storage costs, you need to insure it. Okay? And then we're going to talk about another type of positive yield besides dividend payments on stocks or interest payments on bonds, if that's the asset. So those benefits are going to include the monetary benefits, any dividends, cash flows that flow to the owner of the asset, and also a convenience yield. And there is some controversy about the convenience yield, but for our purposes, we're going to say there is some benefit to holding the physical asset rather than just owning the derivative, the forward contract. And for assets that have this convenience yield, it increases the benefits of holding the asset. So now look at our equation here. The value of this contract at time t, and it's the contract that expires at capital T. So the value during its life at time little t equals the spot price, and this looks very much like what we had before, except now we've inserted this net cost of carry. We're going to subtract the benefits of holding the asset and add the costs of holding the asset. Now, I've called that net cost of carry here. That could be a net benefit of carry as well. Depends on which is larger. So we've got the opportunity cost of the fund, we've got storage, insurance costs from time t to capital T. So this is the remaining amount at time little t. So we've got the present value at time little t of the remaining costs and remaining benefits over the life of this security to capital T. Now let's talk about a forward rate agreement. In a forward rate agreement, we'll exchange a fixed rate for a floating rate. And it's similar to the component of a swap that we talked about earlier. And well, one side says, I'll pay the floating rate in the future, and the other side says, well, I'll pay this fixed rate. Floating rate goes up, the floating rate payer loses, has losses, and the fixed rate payer has gains. Again, there's a notional amount, as we spoke about with a swap. The fixed rate is the contract rate. The floating rate is the underlying rate, so we don't have an asset now, we have an underlying interest rate. So we say the long in a forward rate agreement pays the fixed rate and receives the floating rate, typically LIBOR, the London Interbank Offer Rate. And so the long receives LIBOR minus the fixed rate or pays the fixed rate minus LIBOR, depending on which way the floating rate moves. Now, in an FRA, forward rate agreement, we can create this synthetically, and that's what's going to lead to our arbitrage pricing. So look at this top line here. We want a forward rate agreement, and this forward rate agreement is the rate to borrow for 90 days, 30 days from now. So what we've got is the price of a loan from day 30 to day 120. Well, how could we create a loan from day 30 to day 120? Well, we could borrow for 120 days, turn around, and that's at a known rate, right? The 120-day borrowing rate's known right now. And then we could lend at the 30-day rate, which is also known right now. So we can lend for 30 days. Well, if you borrow money for 120 days, lend it out for 30 days, and then get paid back, what do you have? You have the use of that money from day 30 to day 120 for 90 days. So that's our synthetic FRA. And now we're getting back around to this argument that says, well, law of one price. This forward rate agreement ought to offer you the same interest rate from day 30 to day 120 as you could get by entering into this other transaction, borrowing for 120 days and lending for 30 days. So we'll say, rather than they must have the same price, we'll say that forward rate from day 30 to day 120 must be the same for this forward rate agreement as it is from synthetically creating an identical position. Well, how do futures prices compare to forward prices? Before we've said, well, they're very similar. One's exchange traded, and standardized, and has margin, and these other differences. But unlike forwards, futures contracts, remember, have this mark-to-market. So the futures actually have interim cash flow, so they can require cash to be put in if the margin balance falls below maintenance margin, or if it generates cash above the initial margin requirement, you could actually take that out of the account. You can always draw the balance in your futures account down to initial margin by taking money out if there's excess margin funds in there. So the value of the futures is going to be a gain or loss since the previous day, resets to 0 daily at settlement. So we mark to market on the futures, and then we change the futures price to the futures price that makes the contract now worth 0 again to each party. So futures prices are going to be the same as forward prices if interest rates are constant or they're not correlated with futures prices. And essentially, we treat them as if there's no difference for valuation. But if there is correlation between interest rates and futures prices for some asset, then we have a situation where, let's say that they are positively correlated. So when the futures price goes up, interest rates go up. Well, that would be a good thing, because when futures prices go up, those are positive cash flows to the long, and those cash flows need to be invested over the short term. And if interest rates go up, when futures prices go up, and you have money to invest, but when money is required because futures prices went down, your borrowing costs are lower because interest rates go down when futures prices go down under our assumption that they're positively correlated. So that's a good situation. Futures become attractive then. The variation gives me more interest when the prices go up, and I pay lower interest when the prices go down. That would be a good thing, and that would make the futures more valuable than the forwards, where, of course, negative correlation would come up with just the opposite. Now let's talk about some interest rate swaps. We really defined that forward rate agreement and explained the synthetic forward rate agreement so that we could price that. We could price that future lending agreement off rates that are known today. Now, an interest rate swap, what we want to convince you of here or explain to you is that it's a series of forward rate agreements. Remember, the prices in the swaps, the payments are netted at each date. Well, that's really the same result as an FRA, where I enter into an agreement and say, okay, I essentially promise to borrow at 5%. If rates are higher than 5%, I have gains. I have a right to borrow at lower than the market rate. If rates go down, well, I lose. I've promised to borrow at this rate, and I could have borrowed at this other rate, lower rate, except that I entered into the forward rate agreement. So these payments at each settlement date on a plain vanilla interest rate swap could be replicated by a forward rate agreement. However, remember that the fixed rate is the same all through the life of a swap. Well, if we were to look and say, well, we need a 180-day FRA, we need a 270-day FRA, and we need a 360-day FRA, all based on 90-day rates, they wouldn't all be at the same fixed rate. 30-day rate 90 days from now, and locking in a 30-day rate 270 days from now, the fixed rate side of that may be different. And so the only point I'm trying to make with that is we can replicate a swap with these forward rate agreements, a series, a bundle of forward rate agreements, but they won't be all at the fixed rate if their values are set to 0. But with a swap, these components are all based on the same fixed rate. So they may not be zero value FRAs. So that's why we say, yes, an interest rate swap could be constructed from a series of forward rate agreements, but they're off-market, or they may well be off-market forward rate agreements. Off-market meaning each component doesn't have zero value. But just a minute, we said when you enter into the swap, the fixed rate is set so that neither side pays anything. Both sides of the swap have zero value at initiation. Well, in that case, we can say, yes, some of these off-market FRAs have positive value. Some of these FRAs that comprise an interest rate swap have negative value, but on average, when we add them all up, the value is zero. So to replicate a swap with zero value at initiation, the present values, the current values of all these off-market FRAs must sum to zero. So the swap price is the fixed rate in the swap, and the swap value is positive if the expectation of short-term rates increases, and negative if those short-term future rates decrease after we enter into the swap.